Dean in Kelowna, caller number 1. Good morning, Dean. Welcome to Market Call.
Thanks, Michael. A quick thing to your bosses there in the autumn, maybe they could make this show 45 minutes and split the time with the other show there.
Ah, pass that along. Thank you.
Yeah. Dave, I was wondering if you'd buy Starbucks here, whether it's one of those themes you're talking about. But also, can you help me with the bullish percentage averages? I see they've been driving me crazy. They keep going up, and I feel like I'm missing out. And yet, you got the, this seems to me it's just based on the expectations that the government's going to put money in. So how do you think about that when you're looking at those bullish percentage averages? Thanks a lot.
Sure. So, Dean, let's start with your first question on Starbucks in particular. One of the things that's made this market tricky is that as we've gone along over the last 12 months, a number of the key themes have continued to work, more or less the yield-oriented themes. And as we've gone along, the market has narrowed, meaning fewer and fewer of these themes continue to work. And one of the key themes over the last couple of years has been sort of the consumer discretionary theme, which would take into its group Starbucks. McDonald's is another. And these stocks had a very, very strong move over the course of the last couple of years. And what we've seen over the last few months is that many of them have started to disappoint on the revenue side and on the earnings side. And both Starbucks and McDonald's have shown some slowing in their numbers. So the market appears to be pretty unforgiving right now in these stocks. A number of the retailers also have gone through some difficulty, like, say, a Lululemon. And so I think that right now, given the fact that we're seeing deceleration in some of the numbers, you want to give this group a little bit of time before you refocus on it. Some of the more value-priced areas of consumer discretionary, like consumer discretionary retail, like Costco or Walmart, continue to behave quite well. But some of the higher-end products are having a tougher time.
Tell us about the bullish percentage average and what that means for you when you're making an investment decision.
Okay, so in really simple terms, in our business, we think a healthy market should see an expanding list of stocks participating in a rally, not a deteriorating list. And what we've seen over the last 6 or 8 weeks in the U.S., we've seen some expansion. So about 55% of stocks in the U.S. market are participating in this lift, which is still a fairly narrow list, although it's been expanding a little bit. The Canadian market is not seeing that, partly because of the sectors that make up the Canadian market, right? More economically sensitive groups. So we've seen some expansion in the U.S., and that is confusing for some people because there's lots of issues going on. What it does is it highlights the fact you really need to be focused in those few groups that are seeing net expansion. And it's very much a market where you have to pick your spots. As a manager, to be broadly based in all industry groups right now does not tend to be working very well. You really have to pick your spots, and those groups are the ones you want to focus in.
For picking a spot for an entry point on Starbucks, if $46 isn't palatable to you, because it's already broken down technically speaking, I'm wondering if we have to go all the way back to mid-support in late November of about $40.
Yeah, and that's probably true. We don't tend to try and pick bottoms. I'd like to see some kind of base building and get the stock turned before that. If I were looking in the group at one that probably will give us an earlier entry point, I'd probably look at Yum Brands, which has been basing over the last little bit, and it looks a little bit better technically, and has not broken long-term trend.
All right, Yum Brands at $66.70 today, Dean. By the way, it does have a dividend, 1.7%. Shares are down by 9 cents today. We're off to London now for Jerry. Hi, Jerry.
Hi.
What's your question, sir?
My question is with the telcos. I like BCE here and BCE.PR.A, the preferred. And I like the way George Cope has been running the business with Astra Multimedia. I think that deal's going to go through. And also, I just wanted your view on these two stocks, and I'll hang up and listen.
Sure. Well, let's focus on BCE. So for disclosure purposes, this is one of our biggest holdings at the firm, and has been for probably close to 3 years now. The telecom sector is one that really fits the type of sector that people are looking for. As opposed to looking at sectors that have significant earnings leverage attached to them, what the market is favoring right now are sectors where there is great consistency and predictability of cash flows. Within that group, ideally, you'd like to find companies that have catalysts, things that are changing for the better where you could get a multiple expansion. And we're seeing that in BCE. First of all, they went through their restructuring. Now they're growing some of the new businesses and certainly beating estimates. And as a result, earnings multiples are expanding. In a world where fixed income yields are so low and really not showing much sign that they're likely to rise, companies with very predictable cash flows will trade at a premium. And so I really like BCE. I would continue to purchase it here. I know we're trading virtually at highs, but we own Verizon, we own TELUS, we own BCE. And I think the most important theme in this market to focus on are companies that have a history of and show a willingness to raise their dividend. Because in the late 1950s, we had very low interest rates for about 14 years, between 2 3/4%, 2 and 2 3/4. And in that period, those companies that were able to grow their dividend saw way out performance against the group.
All right, Jerry, there you have it. And BNN is owned by Bell Media, which is owned by BCE. We're going from London to John in London as well. Hi, John.
Michael, how are you?
Good, how are you?
Very well. I tell you, all of our viewers feel safe when you're in the driver's seat, Michael.
Oh, thank you, sir.
Mr. Burrows, my question's on Cisco Mining. Tell me what you think of their earnings that just recently came out. Looked like everything looked fine. They had that week, that 1 week where they had a little hiccup, but production was on key. Year-end production is still in line there. And if you can kind of comment on, are you looking more towards some mid-tier gold companies looking forward, as with the last earnings come out with some of the large caps, they seem to be a little bit riskier by missing production, higher costs, but these mid-tiers seem to be sticking in line with production and lowering costs as they look more of a valuable entry to you.
John, I think that part of the reason the mid-tier stocks are acting a little bit better is that there is always the possibility of mergers and acquisitions activity. And so I think that there is the view that these stocks have been selling off for quite some time, and it's not impossible you can see some deals take place. Having said that, and recognizing that the golds are going through a basing process, I'm not certain that we have seen a turn in this group yet. And there have been several shorter-term rallies up underneath long-term falling moving averages. And Cisco, basically, as it stands right now, is right underneath the 200-day moving average.
What's it going to take to make a genuine concerted turn, and how do we know that it's happened?
Well, I think that, for one, you have to watch the technical price behavior. And, you know, if you look at Cisco, it's traded up underneath the 200-day moving average several times only to fail and roll over.
Currently 10, 11.
We're there now, so we're at the top end of the range. Second thing is that around $9 held a number of times on the way down, and basically we're trading just up and just a little bit above that as it stands right now. So it's into some pretty significant resistance. I want to watch the group. There really are no big outliers in the group that are trading better than the rest. So I think you still have to be a little bit cautious here. Obviously, in the golds, the expectation is if you got QE3 or significant quantitative easing anywhere, that ultimately has the potential for being inflationary, and that would be a go sign for some of the gold investors. The only problem is, in each of the last couple of cases, the stocks rallied up into the news and sold off after the fact. So there is some risk there.
So you need to see consistent support above the 200-day moving average on Cisco before John ought to be looking
right,
at this.
And we would like to see some pretty consistent outperformance in the shares versus the gold price. And we're really not seeing that on a concerted basis yet either.
That's why we've seen CEOs walk the plank.
Yep, that's right.
All right, John, thanks for that from London. Thanks for your kind words, too. We're taking a quick break. When we come back, more of your questions for David Burrows, president of Barometer Capital Management, on North American large caps. There's a line available at 1-855-326-6266. And when we come back, we'll find out what David thinks about research in motion and the latest rumors.